Everybody, and welcome back to another monthly market update with my buddy Tim Holland, the Chief Investment Officer of Orion in Town Square, and for the first time ever in-house.
Yeah, this is pretty neat setup. Good to be with you in person.
Yeah, during the recording. So if you're unfamiliar, Tim does not live anywhere near Fiat. You actually flew here this morning, correct?
Yep.
And where from and where do you live?
So my wife, Meredith, and our kids, Grace and Spencer. We have a dog, Winston, and a gecko, Minnie, that I
don't forget about the gecko.
No, because my son did after we got the gecko, and he moved on quite quickly. So if it wasn't for me, I think the gecko wouldn't have survived.
Do you even know what kind of gecko it is?
It's a leopard.
A leopard gecko?
Yeah. Oh, you almost got me there.
I used to have a lot of reptiles, so
really?
I'm very familiar.
Okay, neat. Yeah, no, we've had Minnie for four or 5 years, and yeah, Spencer was all excited about the gecko, and then quickly lost.
Oh, for sure.
Yeah. So,
but anyway, you knew that was coming.
I should have known it was coming. I'm way too naive, I think. But we live in Wayne, Pennsylvania, which is down the road from Villanova, for those folks that follow college hoops, which is about 30 minutes west of the city of Philadelphia. So I flew out of
Which
Philly.
Does not mean 30 miles.
No.
If you've ever been to Philly, it's nothing but traffic.
Yeah, for sure. So flew out this morning from Philly to the great state of Minnesota. Haven't been up here in a while, and it's great to see you all in person.
Yeah, these are always fun for me anyway. I think it's good for us just every month kind of take a peek back over the last 30 days-ish and what's been going on, and kind of also just have one eye looking forward of what's coming in front of us. But super fun to have you in office and all that kind of stuff. I was actually just out in your neck of the woods.
Yeah,
I was in Philly last weekend, was out there doing a work event, and then traveled west and went to the Iowa Penn State game at Beaver Stadium.
Yeah, it's like 107,000 people or something.
They set an attendance record that night. 110,870 is what they had. Now, the only people that didn't show up was the Hawkeyes.
Sorry to hear that.
The worst. They scored the first time they have gotten shut out in 23 years. But
really
cool experience to be out there with the boys and get to see it. But
yeah,
that's not what people are here for. They're here for a quick market update, and so I want to get to that. That being said, just quick snapshot of what happened in September. We led with this a little bit last month. They're saying September is typically not a super great month for the market.
Yeah,
that ended up holding true. So we didn't have a good August. Now we ran into September, and the S&P was down 4.8%. The NASDAQ was down 5.8%. And now here we are in the beginning of October as we record this. It's not starting off super well.
Yeah.
And even though that's the case, we're in our now third month of a possible pullback. That doesn't seem to be what's on people's minds. It's Washington, D.C.
Yeah.
And so I want to start there, and then we'll come back to the markets. And so can you just kind of give us a little bit of an update of what's going on in Washington and why that news should be important to us?
Yeah. And it's interesting, back to the most recent monthly letter, one of the things we called out that was a positive was a somewhat unexpected deal to avert a government shutdown, to keep things going at least till mid-November. And the idea would be that would give both parties, Republicans and Democrats, a little time to kind of catch their breath and settle down and reach an agreement on something that would prove more sustainable. And then obviously turned out that deal started the clock ticking on Speaker McCarthy and ended up being his undoing. So as we sit here, midweek in early October, we have an interim speaker. Kevin McCarthy said he won't run again. All eyes are on D.C. as the Republicans try and figure out who's going to take that job. And I'm more of a markets person than a policy person, but I would think it's going to take some time, just because the Republican majority is so slim in that House, and that was part of the reason why McCarthy had to make the agreements he made early in his speakership to win the gavel. But that also proved to be part of his undoing. And I just think, given the vitriol around this vote and how divided I think even Republicans are right now in the House and how slim their majority is relative to Democrats, my guess is it's going to take a little while.
Yeah. So that brings uncertainty.
Yeah, for sure. As we move into year end, and there's some big issues outstanding, like Ukraine and funding for that campaign over there, which is not part of the stopgap spending agreement. And you've got to pass a meaningful 12 spending bills by mid-November, or you're going to have to come up with another interim deal. I don't want to see a government shutdown. That's 4 or 5 weeks away. If there is sort of an upside from a markets perspective or an economic perspective, if there's maybe a little bit of a pullback in government spending and fiscal largesse, given where interest rates are and what the bond market's been doing, maybe some of that might be received as a positive. But I think it's going to be a bumpy couple of weeks in our nation's capital.
Yeah, just interesting timing with all of what's going on over there. And now on top of that, outside of, the White House and Congress, we've got the Fed Reserve also having their own battles with what we've got going on in the economy, which is part of the reason that we're talking about these markets in August, September, now leading into October. And so it's easy to have a very short-term memory.
Yeah.
And to kind of forget long-term. It's very hard to stay long-term minded. This is one of the things Warren Buffett is so famous for, is constantly talking about getting invested, staying invested, and not getting so wrapped up in these short-term things.
Yeah.
But it's hard.
Yeah, oh, for sure.
Right. Emotionally, it's really hard not to look at what happened in August and September and then be super worried. And then, add on top of that what's going on in Washington. Where's the light at the end of the tunnel? So like when people look at the economy and the markets, is there anything positive that we can look forward to that would make us believe that this thing isn't going to continue to just go down?
Yeah, I think there are three things you can focus on. And back to Warren Buffett, he likes to quip that his favorite holding period is forever, right? You buy.
Not too many people have invested for 80 years.
No.
Relatively speaking, it is forever.
Yeah. I mean, he just turned 90. Charlie Munger's well into his 90s. So, there's something to be said about just.
Well, I think he started investing at 10, right?
Yeah.
So he's 8 decades into his investing career.
Yeah, there's some fascinating biographies and about his early years and some of the businesses he invested in as a child. And even some of the sort of the machines, it was sort of a vending machine business when he was a teenager, I think, in Omaha. And he loved it because it was just steady cash flow, and you knew where the machines were. Yeah, passive income. And so obviously, brilliant investor and a brilliant way of looking at things. But back to sort of what could and should, and I think we'll turn this around. So we'll go back to the calendar. August and September are historically notoriously bad months for the market, and September sure lived up to that reputation and then some. Once you get into October, November, December, January, going back 70 some odd years, have on average produced returns of 1% plus. It's the only 4-month positive stretch out of all 12 months for the S&P 500. You have a couple other periods where you can string together a couple positive months, but it's the only 4-month stretch of historically positive returns. So we are coming into that seasonally strong.
So regardless of, the economic factors and the political factors going on right now, just historically, we're on trend.
Yeah.
Right. The season of August, September, typically not good, but then we get into this 4-month stretch that again, typically is good.
Yeah.
And so regardless of our set of facts in 2023, we're right where we would expect to be if you're just looking at averages.
Yeah, for sure.
Gotcha.
Sort of the calendar is doing what the calendar has historically done. So we're flipping the page into a more positive month. This is another sort of calendar-driven data point, smaller sample set, but whenever the S&P has sold off at least 1% or more in August and September, at least the last 3 times that's happened. And I know this may be hard for people to appreciate given that, it's an unsettled market right now. In October, the last 3 times that's happened, and those 3 times have all happened in the last 15 years, the S&P has rallied more than 8% all 3 times in October. So I know we didn't get off to a good start earlier this week, but we've got the calendar and seasonality on our side. And then I think ultimately it comes back to what's been roiling the markets the last couple of months, which is the bond market, bond yields, worries about inflation. And so bond yields have moved sharply higher the last couple weeks after moving higher in August and earlier in September, because people are worried that the economy is running maybe too hot. The Fed is too hawkish. The Fed is too intent on keeping rates high. And that means inflation is going to stay up there, and the Fed's probably got to come in and be even more aggressive on the rate hiking front, and that's going to end in a pretty unpleasant recession. So that's, I think, the narrative that's taken hold. What I find interesting, and it's only one data point, is the ADP job number out today. ADP is a payroll processing company. Was very weak, and we get the September jobs number on Friday. I don't like to see people lose their jobs, but if the labor market continues to soften, and it is softening, that should start to tell people that maybe the Fed has done enough, that the economy is slowing but not going into a severe recession. Worries about inflation will dissipate, bonds will go up in value, yields will come in, and stocks should find a floor. And we also have earnings season kicking off in about 10 days as well. So I do think between the calendar, seasonality, how bearish and spooked people have gotten, that's a contrarian indicator. When that happens, markets tend to do pretty well. And my belief that the Fed has gone far enough in terms of hiking rates and shrinking its balance sheet that a little slowing in the economy will manifest itself, and people will stop worrying about inflation so much, and we'll catch a bit into year end.
So you, just to play a little bit of devil's advocate, you really think that that one data point is enough to kind of turn some sentiment at the Fed?
Yeah, I think we'll get Friday. Now we're only 2 days away. If we get a really strong print for the September jobs report, which comes out this Friday, then that kind of takes the ADP number from today and kind of throws it to the side. But I do think that between now and when the Fed meets, and they have a 2-day meeting, the last day in October, first day in November, and then they meet again in December, you're going to get a couple important inflation data prints, and you'll get the September jobs report. And unless those numbers surprise to the upside, I just don't see how the Fed can justify or would want to raise rates any more than they already have, even though I know they're telegraphing that. They've been telegraphing that for a while. I just think things are slowing. The labor market is slowing, and that you're going to be in a position where people are of the mind that the economy is going to weaken a bit, not a severe recession, but weaken, and the Fed can kind of really stay on hold. And I think that'll be a good thing for the markets for sure.
So you said three things. One was the calendar. The other one is this jobs report, which again, we're not hoping people lose their jobs, but if the labor market is softening, the expected result is anyway, that the Fed won't be so hawkish and they'll actually not continue to raise rates. What was the third point?
So when you put those two things together, the idea would be, or the narrative that takes hold is, okay, the economy's slowing, not a severe recession, bond yields start to come in, which means bonds catch a bid, which is going to be good for that asset class, but lower bond yields just then support equities, right? Because, we live in a relative world. Even if you say I want all my money in cash, which is, in my opinion, never a good place to be, you've made a decision. It's cash relative to stocks or bonds or real estate. So we live in a relative world, and with the backing up in bond yields, bonds are more attractive. So it's a good time to buy high quality fixed income for sure. But that makes stocks less attractive because you get higher coupons, and higher interest rates are bad for equities. So if you do put all this together and you see yields come in, one, that's going to support stocks because it'll make stocks more attractive because yields are lower, and lower bond yields make the future earnings that companies are going to produce worth more. So if you put all that together, along with what I think has become very bearish sentiment in a very short period of time, there's a lot of people that have already moved to that one side of the boat, and I could see a lot of that money and those people coming back. And that's how I think the fourth quarter is going to play out. If it may not, but it seems like we're setting up, and history really is a guide here. After the worst 2 months of the year, sentiment's very bearish, bond yields have spiked, people are worried about inflation. I think enough bad news has been baked in that you just get some moderating data on the labor front. I think we're going to get it. You should have a pretty good October, November, December.
So do you think, last question on this, before we wrap up, is, let's just say the Washington thing that we led with doesn't get figured out. Do you think that these 3 points that you brought up, the calendar, the Fed, or the labor, and then into this final point, that they can overcome an unstable Washington and we could still see a rally? Even if, because to your point, and I agree with you, I don't think this is going to get solved tomorrow in Washington or anytime soon. I mean, it took them a long time to put the first speaker in. I just can't imagine that this one's going to go super well. Plus we only have 4 to 5 weeks before we've got to pass another spending bill. So if that stuff doesn't play out well, do you think that we can still see some sort of at least stabilization, if not kind of a rally here in the fourth quarter?
I think so. When we've had government shutdowns in the past, and a couple have run for a couple of months, it's had a nominal impact on the economy and the markets. Obviously, what's different now is, you saw for the government shutdown on an interim basis, but now you don't know who's driving the bus on the House of Representatives side.
There's a joke there.
There's
the government shut down for a couple of months and nobody even cared.
you know, and
the markets did just fine.
So it's happened before, and it's really, you know, and it seems like it's become almost an annual occurrence the last 15 years, though it has happened prior to that. But what is different is we don't have a speaker. So to your point, we've got till mid-November. I would, maybe this is me being naive again. You know, sort of back to the gecko. I would hope in the next 4 to 5 weeks, they're going to be able to land on someone to have that, take that role on to hold the gavel. You've got spending covered until then. I think if you can get there, and even if you have a government shutdown following that, I think the markets will be fine. I think the markets will actually feel better that at least we know who's driving the House from the Republican side, from the majority side. So we've seen shutdowns happen before. They've had a nominal impact. Again, what's different is we don't know who the speaker is, but I assume they'll have that job filled by mid-November.
That's a lot.
Yeah.
But at least it's good to hear. And that's kind of what I was hoping to get out of today, is that there's some sort of hope out there, right? Because it's very easy as an investor to just get very short-term minded, to get so focused on what's happened just yesterday, last month, the last couple of months. It gets really hard to kind of remember that although there are some pullbacks, correct me if I'm wrong here, you're the numbers guy.
Yeah.
We're still up this year.
Yeah, about 11% on the S&P 500, north of 20 on the NASDAQ.
Yeah.
You know, small cap stocks have struggled because bond yields have gone up. And so again, you know, everyone likes low cost money. Certain parts of the market like low cost money in particular, like small companies, because they tend to need more funding. So again, if you think that yields are peaking, and unless there's some inflation pressure out there that no one's really seeing, I think they are, then again, bond yields should start to come in. That's good for stocks at a high level, really good for small cap stocks in particular, good for those growth stocks like the big tech companies that have sold off pretty meaningfully here. But to your point, you know, we're up about 10% and we're going into by far the strongest part of the calendar. It's not even close.
Yeah.
So history would tell you, and I'm probably going to jinx it, so I should probably stop talking right now. You know, if you're up 10,
I don't think you have that much power.
I really don't. I clearly at my house, I don't.
No, none of us have any power in our house.
Come on, you're very kind. You know, if history's any guide, you know, the fourth quarter for a year like this year, when you're already up going into it, tends to give you anywhere from 5 to 10%. Yeah, I mean, this is historically the strongest part of the calendar, but also when you go into the fourth quarter with gains, those gains tend to perpetuate and sort of compound on top of themselves. So I'm pretty optimistic into year end.
Love it. Tim, thanks for physically actually being here for this month's market update. I don't know that we're going to get to do this very often, but awesome that we got to do it at least once.
Yeah.
That said, I just want to end by saying to everybody, there's always some sort of optimism, but this is also why, and we said this last month, I'm going to say it again, this is why you don't invest based on short-term outcomes. You invest based on the outcomes that your family needs. And as an investor, you need to stay, if you're going to invest, you need to invest. Gambling is one thing. If you're going to get in and out of the markets, that's gambling.
Yep.
If you want to be a part of the long-term capital markets, this should be the expectation.
Oh, for sure.
And knowing that this should be the expectation, it should be baked into your overall plan. You should be able to stave this off, is I guess what I'm trying to say. And so good to know that there's some sort of optimism out there, because when you watch the news right now, there's not a lot of it.
No, and we all know this. They do that on purpose.
Well, of course.
Right? We're all hardwired, you know, for all sorts of reasons to be scared and not be optimistic. And so they're geniuses at social media companies, at the big media companies, for just pushing those buttons. And fear sells, and they pile it on pretty thick, which is not cool, but I guess it's good for their businesses.
Fear and greed, right? They're the two emotions that elicit the most response and action. So Tim, thanks again. Everybody, thanks for joining us for October's monthly market update. We will be back with you in November. Enjoy the rest of your day.